So imagine you are looking at a tech giant that just posted a massive 25% revenue jump. I mean, it's literally their highest revenue growth in 15 years.
Right, which usually means everyone is thrilled.
Exactly. But you look over at Wall Street, and half the analysts are pounding the table screaming strong buy, while the other half are, furiously typing up strong sell notes.
Yeah, you really rarely see this level of polarization for a legacy company of this size. I mean, we are looking at a violent tug of war between a very real operational reality and, well, deep market anxiety.
It's wild. Well, welcome to the deep dive, everyone. Today we are tearing into Intel's Q2 2026 earnings.
And we have a lot of material to go through for this one.
We do. We've got a stack of 11 institutional and independent research reports right in front of us, along with a pretty massive, comprehensive Q2 2026 meta-analysis deck.
Which we definitely need to make sense of all this.
Yeah, because our mission today is to decode what these sources are calling the 60x valuation paradox.
Right.
We're going to contrast these fiercely debated bull and bear market positions to figure out, what is actually happening under the hood.
And my role here is really to help separate that daily market emotion from the operational reality. Because we have to look at the AI-driven renaissance happening inside Intel's data center division, right?
Right.
And then we have to weigh that against the staggering, just historically unprecedented capital risks they're taking on in their manufacturing arm.
Yeah, so to even understand this intense debate, we first have to look at what triggered that massive Q2 revenue beat in the first place.
Which is the data centers.
Exactly. It all comes down to data centers. The data center and AI segment, DCAI, it just exploded. Revenue jumped 59% year over year to $6.3 billion.
And what's fascinating is the core driver behind that. It isn't just general computing growth, and it's not even the standard AI hype cycle we've been seeing for the last few years.
It's something different.
It is. It's a fundamental shift in how artificial intelligence operates, specifically this rise of agentic AI.
Right. Okay, let's unpack this for a second. Because when you hear AI, you instinctively think of NVIDIA and their GPUs.
Of course, that's the narrative.
But agentic AI is mechanically different. Standard generative AI, like, when you ask a chatbot to write an email or whatever, it relies heavily on GPUs because it's just predicting the next word based on massive pattern recognition.
Yeah, it's very linear.
Exactly. It's linear. But agentic AI involves autonomous agents that actually execute tasks. They check databases, verify permissions, trigger external scripts, and they make independent decisions based on changing variables.
Right. And doing all of that requires really complex branch-heavy logic and rapid system interrupts. And honestly, GPUs are terrible at that.
Since they're just not built for it.
Exactly. A GPU is essentially thousands of relatively simple processing cores doing the exact same mathematical equation at the exact same time. It's just brute force.
Right.
But a CPU, like Intel's Xeon processor, consists of a few highly advanced cores that are designed to handle unpredictable, complex operations sequentially. You really need the CPU to act as the orchestrator.
So if GPUs are the star athletes scoring the points, the CPUs are the coaches calling the complex plays.
That's a great way to put it, yeah. As AI becomes more agent-based, you cannot just stack thousands of GPUs in a rack and expect them to function autonomously. They absolutely need heavy CPU orchestration to manage the memory and execute that logic.
And the market data in these reports proves this out. The demand for Intel Xeon servers is surging right now.
Oh, massively.
Yeah, unit volume, like the actual physical number of chips shipped, was up 9%. But the average selling price, that was up an incredible 48%.
That's just staggering.
I mean, they are selling 9% more silicon, but they're charging almost 50% more for it.
Well, because Intel is rationing supply. The demand for their new Xeon 6 chips is completely outstripping their manufacturing capacity, which creates this immense scarcity pricing.
So people will pay whatever they ask.
Yeah, and the bulls are looking at this and saying, look, Intel is finally monetizing the AI boom beyond just the GPU narrative. I mean, they have absolute pricing power in the server rack right now.
And you can see that pricing power hitting the bottom line. The DCAI segment's profitability just went into overdrive.
Right, the margins.
Yeah, we're looking at a 56% gross margin, which is an 840 basis point expansion just from the previous quarter alone.
It's huge because when you are selling your premium mix at a 50% markup, Almost all of that extra revenue bypasses the operational costs and just falls straight to the profit line.
Right. And beyond the off-the-shelf CPUs, the long-term structural wins are what have the bulls truly excited, right?
Yeah, absolutely. Intel recently locked in 10 multi-year supply agreements,
Mm.
and the real standout there is an incredible order from Alphabet for 3 million custom tensor processing units to be delivered in 2028.
Wow, 3 million units.
Yeah, and because of deals like that, Intel's custom silicon division, their ASIC revenue, is up nearly 3 times year over year to $951 million.
So they are really proving they can be a trusted custom design partner for the hyperscalers.
Yeah.
Google, Amazon, Microsoft,
Yeah.
rather than just a vendor selling universal parts.
Exactly.
But here's where it gets really interesting. Hearing all of this, the 59% growth, the 48% price hikes, the Alphabet deal, you would assume Wall Street is throwing a parade. But half the market is terrified.
Yeah, they are, because the bears are looking at the price tag attached to the stock, which they argue requires a flawless, mistake-free execution of Intel's entire corporate turnaround strategy.
Which they obviously haven't achieved yet.
No, a perfection that Intel has definitely not achieved yet.
The reports actually refer to this as a grotesque mismatch, because Intel is currently trading at a forward PE of roughly 60x.
Right.
But then compare this to the undisputed AI leader, NVIDIA, trading at just 16 to 23x, or AMD is at 38x,
Right.
TSMC is at 24x.
It's a huge gap.
Wait, so the company growing the slowest in its peer group is somehow the most expensive? That's like paying a premium price for a Ferrari but getting a minivan. Why is the market giving them this 60x premium?
Well, you have to look at the margins. You don't pay 60x forward earnings for a company with an overall EBIT margin of just 3.7%.
3.7% is so low.
That 3.7% margin is the defining metric for the bears. Compare that to NVIDIA sitting at roughly 64% or TSMC at about 56%.
So that 60x valuation basically leaves zero margin for error.
None. The market is pricing in the eventual future success of Intel's transformation. All the good news is already fully priced in today. If one single structural block falls, the valuation collapses.
And there are plenty of competitors actively trying to knock those blocks down. I mean, NVIDIA completely dominates the high-profit AI accelerator market.
Right.
AMD is relentlessly eating into Intel's traditional server CPU market share year after year. And then you have ARM architectures, like Amazon's custom AWS Graviton chips, threatening the Core by 86 ecosystem that Intel built its entire empire on.
Yeah, and that ARM threat is existential. Historically, Intel's x86 architecture dominated because it had a massive instruction set. It was basically a Swiss Army knife, could do anything you asked of it.
But that requires a lot of power.
Exactly. It runs hot and uses a ton of energy. ARM architecture, on the other hand, is more like a scalpel. It is streamlined, specialized, and highly power efficient.
Which is exactly what hyperscalers want.
Right. When companies like Amazon are running hyperscale data centers where electricity and cooling are literally their biggest costs, they are highly incentivized to transition away from power-hungry x86 chips toward their own custom ARM chips like Graviton.
So the bearish analysts actually ran a discounted cash flow model based on these exact competitive threats.
And the numbers are brutal.
They are. According to their DCF, if Intel doesn't execute perfectly to fend off AMD and ARM, its intrinsic value is calculated at just $34.34 per share.
Wow.
Yeah, and the stock is hovering around $92 right now. That implies a roughly 62% drop if things simply go normally instead of perfectly.
So you have very real, tangible AI growth on one side, and then a stock price demanding absolute perfection on the other. But the biggest structural block that could trigger that 62% collapse
The anchor dragging Intel's overall margins down to 3.7%.
is their Foundry business.
Yeah, the manufacturing division. Which is crazy because, on paper, the Foundry revenue looks like a massive turnaround success.
It does look good at first glance.
Right. Up 31% year over year to $5.8 billion. But then you dig into it. Out of that $5.8 billion, $5.48 billion is just internal segment elimination.
Yeah, which means Intel's design team is essentially just paying Intel's manufacturing team.
Exactly. Only $293 million, which is roughly 5% of that revenue, comes from actual external commercial customers.
So it is entirely internal money moving from the left pocket to the right pocket.
So it's like spending $20 billion to build the world's most advanced, massive restaurant. But right now, the only person eating there is the chef in the back.
That is exactly what it is. And keeping the ovens running in that empty restaurant is burning cash at an astonishing rate.
I mean, how much cash?
Well, the Foundry posted a $2.1 billion operating loss in Q2 alone. Annualized, that translates to an $8.4 billion cash burn.
And they aren't slowing down their spending to fix the burn rate either. The sources note they actually raised their 2026 capex to over $20 billion.
Yeah, they are doubling down.
They are.
And if we connect this to the bigger picture, this is the timeline that will make or break the company. Intel is spending $20 billion a year building capacity as if those external customers have already arrived.
But they haven't.
No. The reports project that external break-even isn't going to happen until 2028 or 2030. They are placing a massive existential gamble on their upcoming manufacturing nodes, specifically the 18A and 14A nodes.
Let's talk about why those specific nodes are such a massive gamble mechanically. Because this isn't just about making chips slightly smaller, is it?
No, not at all. These nodes involve angstrom-era technology. We're talking about moving below 2-nanometer transistors.
That's incredibly small.
It is. And at that microscopic scale, you run into severe physics problems, primarily electron linkage. So Intel is implementing something called backside power delivery, which fundamentally changes how the silicon is wired to manage power more efficiently.
Which sounds incredibly difficult to do.
Oh, it is incredibly difficult to manufacture without defects. If a silicon wafer has too many defects, meaning the yield is low, the cost per usable chip just skyrockets, and the node is a commercial failure.
So the bull case relies entirely on Intel mastering this complex backside power delivery, achieving high yields, and then landing what the industry calls whales, right?
Right. Massive external clients like Apple, Tesla, or Qualcomm, specifically for these 18A and 14A nodes.
And if they do that, the math works out. The earnings eventually catch up to the price. That massive 60x PE ratio compresses naturally by 2028, and the bulls win.
Yeah. But if they don't land those whales, or if TSMC simply beats them on yield and cost, then building out that capacity becomes one of the most historic destructions of capital in the history of the tech sector.
That is a terrifying thought for investors. But while the market is hyper-focused on this epic tug-of-war between the booming data centers and the bleeding foundry, the research reports highlight a third dynamic.
The one masking the company's true vulnerability.
Right. The Client Computing Group, or CCPG. This is the division that makes the processors for everyday laptops and desktop PCs.
And the numbers here present a very similar illusion to the Foundry. CCPG revenue grew 13% year over year to $8.9 billion. By volume, it is their biggest revenue driver. But the underlying physical unit demand for PCs globally is actually shrinking. The broader PC market is forecasted for a low double-digit decline this year.
Wait, so what does this all mean for you, the listener? If the PC market is shrinking and fewer people are buying computers, how is Intel's revenue up 13%? Isn't that just a house of cards?
It really is. The growth is being driven almost entirely by aggressive pricing actions and a shift toward premium AI PC mixes.
So they're just charging more.
Exactly. They're charging significantly more for high-end chips to offset the reality that they are selling fewer chips overall.
And there are supply chain choke points making this even more fragile. You have severe global shortages right now in memory components and substrates. You know, the foundational physical materials needed to package these chips.
And those shortages inflate PC prices across the board. When hardware prices spike, consumer and enterprise buyer demand is suppressed even further.
People just hold off on buying.
Right. The expectation in the market was that a massive Q4 holiday catch-up would occur, driven by the hype of AI laptops. But the independent research clearly states that this potential is capped.
Because they can't make them fast enough.
Yeah, there literally are not enough substrates and memory components available to flood the market, drive prices down, and spur volume sales.
Wow, so it's basically stagflation inside a microchip. Prices are up, volume is down, and they physically can't build enough to change the dynamic.
Yeah, and this specific vulnerability in the PC market is exactly why we see so much caution across these reports. When you synthesize all 11 institutional notes, the aggregate investment score is a highly cautious 2.8 out of 5.
So basically a hold.
A hold or equal weight, yeah. The baseline institutional recommendation is to wait. Do not buy into the 60x valuation based purely on the data center growth. Wait until you see external foundry revenue actually exceed internal transfers.
Right. Wait until the public starts eating at the restaurant before you invest in the building.
Exactly.
And that brings the 60MAIA valuation paradox into sharp focus. Just to recap, Intel is achieving very real 15-year high operational wins. Agentic AI is driving massive server demand, and they are commanding absolute pricing power in the data center.
But to get that, you have to accept a $20 billion capital black hole in their manufacturing foundry alongside this artificially propped up PC market.
Which is quite a pill to swallow.
It is. But regardless of whether you actively invest in semiconductor stocks or not, understanding this paradox reveals exactly where the broader tech industry is heading.
Yeah, how so?
Well, for the last 2 to 3 years, the sole focus of the AI boom has been on acquiring GPUs. Whoever had the most NVIDIA chips was winning the race. But Intel's Q2 reveals that the bottleneck in the AI supply chain has moved. Exactly. The bottleneck is no longer just raw compute power. It is the CPU orchestration required for Agentic AI and the physical foundry manufacturing capacity needed to string all of these advanced architectures together. The infrastructure phase of AI is maturing rapidly.
Okay, so up until this point, we have analyzed Intel strictly through the lens of traditional finance and engineering. We've talked PE ratios, gross margins, backside power delivery, capital expenditures, all the numbers.
The standard metrics.
Right. But we need to zoom out for a second because there is a massive geopolitical reality hanging over all of these numbers.
Oh, absolutely.
The U.S. government views Intel as a critical strategic national security asset. I mean, the explicit goal of the U.S. government and the Department of Defense is to counter overseas manufacturing dominance, specifically TSMC in Taiwan, right?
Yes, to secure the domestic supply chain.
And they are heavily backing Intel with billions of dollars via the CHEPS Act to ensure this foundry turnaround doesn't fail.
And the implications of that support completely skew standard financial modeling. I mean, if a company is deemed too strategically important to fail by the federal government, applying a standard discounted cash flow model might fundamentally miss the point.
Because the risk is artificial.
Right. The U.S. government is effectively acting as a backstop against that worst-case $34 per share scenario.
Wait, if the Department of Defense is actively funneling grants, loans, and tax credits to ensure those 18A nodes come online, regardless of short-term external commercial demand, does a 60x multiple even matter anymore?
That's the million-dollar question.
Right. Like, are Wall Street analysts measuring a government-backed utility with the wrong ruler? If the alternative is the United States entirely losing its sovereign semiconductor manufacturing capabilities to Asia, you could argue that paying a 60x premium for Intel right now is actually remarkably cheap for a geopolitical insurance policy.
It just shifts the entire risk profile. The analysts screaming strong sell are looking at the $8.4 billion cash burn and the 3.7% margins. But if the Treasury and the Pentagon are looking at that same cash burn and viewing it as necessary defense spending to maintain technological sovereignty,
then the standard rules of capital destruction just no longer apply.
yeah, it fundamentally changes how you have to value the stock. You aren't just betting on their ability to master sub-2 nanometer transistors, you are betting on the U.S. government's willingness to subsidize them until they do.
That is a heavy thought to mull over the next time you see a headline about semiconductor valuations. I think we will leave it there for today. Thanks for joining us on this deep dive, and we'll catch you on the next one.